we are going to begin today's conversation with Parthib Srivathsan, Head of Platform Companyon Ventures. Parthib, welcome to the show.
Thanks for having me on, and it's nice to meet you.
So Parthib, tell us a bit about your background as well as about your firm.
Sure, absolutely. I've been involved with entrepreneurship for most of my career. I've been working with startups for about 18 years now. 8 of which I spent as a founder at a learning and development services firm that I grew from scratch to an exit. This was back in India. I moved to the US in 2012. I'm now a co-founder at Companyon Ventures. Companyon Ventures is a Boston-based venture capital firm that invests in post-seed, pre-series A companies, primarily B2B technology startups. We typically invest in companies that are just past the seed stage, but not quite at the size of an A round yet, and that's our primary focus.
And how big is the fund?
We're investing out of a $40 million fund. And one key aspect that I should mention is we have so what I do specifically at Companyon is I head the Companyon Ventures platform team, and this is a team of subject matter experts with competencies around sales, marketing, finance, and analytics. We're essentially acting as an operational team for the investments that we make, helping them scale up quicker, faster, more efficiently. In terms of our investments, we typically invest in price rounds. These are rounds that are usually around $3 to $5 million raises, and we lead those rounds more often.
And geographically, you invest in the US, in India, where do you invest?
We've been seeing deals all across North America, because it primarily has been here in North America, and we also see a few deals in Europe as well.
Not India?
Not India.
And where in the US are you based?
We are based out of Boston, but again, that's our operating base. We are, I guess, as far as the US goes, we are fairly
all over North America.
Yes.
Okay. Now, talk a little bit about within B2B, what is your investment thesis? What do you like to invest in? Where do you have special competence in, so forth?
Got it. Well, I think we categorize ourselves as being sector and technology agnostic. We pay more attention to business fundamentals. I think we are more stage specific. So we look for companies that have a strong team, have a sustainable business model, have great distribution dynamics, have strong market tailwinds supporting them. But having said that, we don't invest in B2C or healthcare or life science companies.
What about stage? What do you want to see in a company that is trying to raise a $3 million round that you would be leading? What do they have to have in place?
Awesome. So specifically, what like I said, I think the rounds that we invest in go by different names. It's typically a C plus or a C2, or it's sometimes called a pre-series A. So I think if I had to describe companies that we invest in, we're looking specifically for capital efficient companies that have launched their product and have early evidence of product market fit. In terms of numbers, this typically translates into companies that have $1 million to $3 million in revenue, and are specifically raising the capital to double or triple their revenues in the next 12 to 18 months.
Okay. Let's do a few case studies of companies that you have invested in, and as you describe these, tell us when did you see them, how did you find them, what did they have that convinced you that you wanted to write the check? What I'm trying to do is get a little bit into your head to see how your firm looks at investments.
Sure. In terms of deals that we see, we play, I think we fill a vital gap in the venture ecosystem, which is at the right in between a seed round and a Series A round. The way we typically work is we have really strong relationships with other venture firms. We have a strong relationship with the A series firms, which have identified companies that are really interesting but don't quite check their boxes yet as far as investment goes, and are tracking them. So that's a great referral source that we leverage to find great deals. Similarly, we've got a very strong network of angel investors and seed investors who have made great investments, and we look at portfolio companies that are quite right at the stage that we look for. So these are two primary deal sources that we work off of. If I had to give you a specific example, our most recent investment has been in a really exciting company called RoadSync. RoadSync is an Atlanta-based startup. They're in the digital payment platform for the transportation industry. We found them. We were really excited about the deal. We found them through. I mean, they were a referral because we co-invested with Based in Partners and Hyde Park Venture Partners on the deal. They check all the boxes as far as our investment theses goes. They have a great product. They have great market traction already. They were solving a problem. Very interestingly, is they were essentially bringing into the 21st century an industry which hasn't moved forward as far as the technology adoption goes. So the problem that we're solving was taking a really manual, cumbersome, paper-based transaction aspect and making that completely digital, which was really exciting for us. And it essentially checked every box that we looked for. So they were doing more than $1 million in revenue. They had really great traction, like I said, and really good prospects in terms of growth in the next couple of years.
And when you say you have an operational team that works on your ventures, in this particular case, what did your operational team do for the company? We announced the deal on the 1st of April, so it's still early days. But if I have to talk to you about what we typically do, our competency is primarily around go-to-market. We act as an extension of the startup itself. So the way we think about this, or the way we approach engagements, is to identify areas where the team potentially lacks depth or lacks expertise in. And what we do is go down into the team, roll up our sleeves, and actually start doing the work along with them. So this could be something as simple as helping them with introductions, could be something more intensive as doing market research, doing voice of customer studies along with the team, helping them figure out where their product is going, maybe help them identify customer segments, pricing sensitivity of their customers. So any kind of research that would further their growth agenda is what we can engage on. We followed that through with helping them leveraging our finance competencies, which is around saying if they are going down a specific path, what does that strategy mean in terms of impact on their cash runway, impact on their customer acquisition cost, impact on their customer lifetime value. So essentially help them build out a full 360-degree view on the impact of the business based on different strategies that they could pursue. And again, we could also follow this through with helping them staff the functions with the right people at the appropriate time. So we don't, I think very simply put, we see ourselves as an extension of the team, think of us as experts that go in and are not shy about getting down to work, rolling up our sleeves and doing all the hard work that's required, and doing everything. We're really true, think of ourselves as partners to the CEO and the executive team. Let's do another example of another company that you've invested in and go through some of the same kind of analysis on how did you find them, etc.
Sure. Another interesting company that we've invested in is a company called smartwid.io. This is a company which deploys artificial intelligence to help the construction industry mitigate risks as far as accidents and incidents go. a key thing. So like I said, we're not really specific on the type of role that we could play. We look for gaps that we can essentially fill. With respect to Smart Grid, I think what we helped them do was essentially we incubated a team to help them with machine learning. So they deployed artificial intelligence to identify security concerns based on feeds that they could get from cameras and from photographs. So we incubated an image tagging team for them to help accelerate their AI development. And we built out a small team. We did that for a little while, and right now the team is actually a 35-member strong team that helps them build that assets to help with further their machine learning and their artificial intelligence deployments.
But that's not go-to-market, that's implementation.
Like I said, yes. So it's the entire spectrum of anything that we could help with. So it starts with go-to-market, it moves to operational, and it ends with helping them understand the financial implications as well. So
and who pays for this?
So these are engagements that we support our portfolio companies with. So if it's from our team, obviously it's the work that we do as a part of our contribution. And and we also recommend partners that they could work with. So those are direct relationships that our portfolio companies might engage with third-party vendors as well.
So, but this case study that you provided of building a 35-member team, that I assume the startup's paying for it, yeah?
They pay for the team, yes. We don't own the team; they own the team.
Yeah. Okay, got it. Now,
I, for instance, went help them kind of frame out the process and think about how they should be doing this, and then they then went on to hire a team and to build around that.
Okay. What trends are you seeing in both your portfolio and in your inbound deals right now? We are in, May 2020, in the middle of the COVID crisis. What are you seeing?
Well, things haven't really changed much in terms of our deal flow. We still continue to see high growth B2B tech startups that have found product market fit, have begun to rapidly scale, and are still a year or two early for most Series A funds. So that's been a constant, and that's probably because maybe it's still early days as far as the COVID-19 crisis goes. So that aspect hasn't changed. We also see, like I said, we see a lot of deals referred by Series A or seed investors, so that's been fairly consistent. But as of right now, I think it's too early to tell about the impact of COVID-19 on our deal flow, because our deal pipeline is still fairly robust and solid.
And what trends do you see in general in terms of types of companies? Are there any, any highlights of what kinds of companies are we seeing in 2020?
So we have a very specific focus, and we've built our deal flow relationships to kind of deliver companies that fit those criteria. So in terms of what we are seeing, it's largely been B2B tech companies that are.
Well, I said that I'm trying to double click down on B2B tech. B2B tech is a pretty broad thing, so
so it is B2B. I think it's a dynamic of what we look for. So given that we are fairly industry and sector and technology agnostic, so we see deals from AI to Bitcoin to blockchain it's been very, very broad based, and these have been companies with ambitious visions and great cutting edge solutions for large markets as well. So it's not.
Do you do cybersecurity, for example?
Sorry?
Do you do cybersecurity?
Yes, we do. So like I said, so our criteria is pretty very, very broad. We're agnostic, so it's more state specific, and that's where we see where we can what fits us and where we can add value.
Okay. All right. And are you looking for unicorns? What is your small fund? And where the question is coming from is that, some of the smaller funds are trying to differentiate by looking at capital efficient deals that would seek early exits and not necessarily unicorn. So how is your firm structured, and how do you look at your investment thesis in that context?
I think that's a great question, right? I think to a large degree, we've already seen a correction in the way how early stage investors are thinking about capital efficiency. And I think it's kind of it started with a series of disappointing tech IPOs that Wall Street showed that it's pretty much showed that Wall Street didn't have too much of an appetite for unicorns without a profitable business model inside. The way we think about it, we've always been very pragmatic in our approach to investing in early stage companies. Capital efficiency is a core guiding principle of ours. We do follow on in subsequent rounds. We participated in secondary offerings that later stage VC sometimes inject into their deals. But as far as we go, I think very close to our hearts, very close to our thinking all the time is a capital efficiency and how capital efficient startups can be. So that is front and center for us.
So you're not necessarily trying to play the unicorn game. You are open to early exits and smaller exits.
Yes, we are. But again, in relative to our size and relative to our investment size and relative to what we are looking for. So just to elaborate a little more on that, we're generally investing in post-money valuations that are between $10 and $20 million. Most of the companies that we are seeing are already in well past that $1 to $2 million ARR range. So the exits that we're looking, so we're looking for successful exits that make a ton of sense in the context of the deals that we've entered into. We're not.
So
Sorry.
What is your preferred exit stage? Are we talking $100 million exits, $200 million exits? What is the point at which you're trying to look for exits?
We're not specifically looking for an exit. We're not artificially trying to inject an exit. I think that's something which the market dictates more than anything else. Obviously, just as any other venture capital firm, we are looking at IRR and we're looking at the multiple on invested capital as key performance metrics for us. So I think anything that helps us deliver on those key metrics that we hold ourselves accountable to is what we'd look for. So if it is a really early exit when it makes sense, I don't think we can generalize and say it's a dollar figure. I think it's very contextual based on the investment that we made, the prospects the company has, the growth that it's been showing, what's potential it has in the future. So maybe it's a much smaller exit, less than $100 million in some cases. Maybe it's an exit in the $50 million range, or maybe it's an exit in the $1 billion range as well. So I think that's a little difficult to characterize. But I would say it's situational. It's very specific to the type of investment that we made and the prospects of that company.
So last question actually on this. Some of the smaller funds are exiting into larger funds because there's quite a few very large funds right now who are willing to play that game. Is that something you are seeing?
Not well. Given my limited view on the piece, I haven't encountered too much of that at this point. My partners might have seen some of these, but from my perspective, I think it's not something that I've seen or I've been very familiar with at this point.
Oh. All right. Is there anything else about your work that I should have asked you that I didn't that you would like to highlight?
Well, I'd love to talk a lot more about all our portfolio companies, but I think you've covered a lot of ground. Like I hope, I'm curious, and I'm hope that whatever I said provides your audience with the insights or the angles and aspects that they were looking for. So I'd love to know if there was something else that you think I could talk more about, which might be helpful for your audience.
Well, this is the beginning of a relationship. What we do when we bring investors that we haven't worked with before on to this series is basically just start the process of getting to know you. And as deals come up, we will have a chance to interact and learn more about your work.
Awesome.
Thank you for sharing.
So if I could just add to that, I think one thing I didn't mention is one aspect which is another deal flow opportunity that we try to leverage is that my platform team, I keep about 20% of my platform team's time dedicated to companies outside of the portfolio. So these sometimes are companies which are, and this takes different forms. Sometimes this is a mentoring relationship to help a really early stage company where we think it's interesting and has prospects. It could be a company which is not quite at our stage, but is one stage removed, in the hope that we're on their radar. We get some kind of a working relationship with them to understand them more.
Okay.
I'll talk a bit about that as well. So I'm happy to review if you have interesting companies or companies that might benefit some kind of mentoring. We're more than happy to help collaborate and provide something there.
All right. Sounds good. I will definitely keep that in mind. Thank you for coming, Parthib. I hear that you're getting on a plane. Is that the first time you're doing that?
On a plane. We do have a series of workshops that we've scheduled for the next 2 weeks, remote workshops. And I have one starting off in a quarter of an hour. So that's everything.
Okay, good. I was a bit concerned about getting on plane.
Yeah.
All right. Well, stay safe, and we will keep in touch.
Sounds good. Thanks so much, and you stay